Hey, and welcome back to another portfolio review video. It's been a while since the last one, and there have been a lot of changes since then. Mostly because of all the new releases, but also just in general, shifting some positions into ones I believe will perform better in the long term. Before we get started, if you want to support the channel and continue following these videos, you can help by joining as a member of the channel, or just simply subscribing for future videos. With the last video, we finally crossed the 2,000 subscriber mark, and now the goal is to see if we can hit 3,000 by the end of the year. Okay, with that out of the way, we can get into the portfolio details now. So for transparency, this is the homepage of the Wealthsimple account. And here you'll see the total value of the account at $120,896. $38,613 of that is gains, and it's equivalent to 47.59% return all time. And this will be over the course of a 3-year period, where I first started investing in July of 2022. And if I move the mouse over to where we are today, you'll see that the net deposits are $81,133. These values also include the checking account, which I just created recently to try it out. So with the Wealthsimple updates recently, you can click below where the all-time return is and I'll take you to a different page. And here we'll get different values from the home page. So here we'll see for the investment accounts, it's at $118,995. And for the net deposits, it's at $80,383. $38,612 of that is gains, and then $12,054 of that is unrealized. So the total return here says how much we've gained or lost, including dividends, interest, and any fees. There are also two other return rates, a simple return rate and then a time-weighted return rate. For the simple return rate, it's how much your holdings have grown compared to what you deposited. And then for the time-weighted return rate, it's how your holdings have performed since you started investing, without factoring in deposits and withdrawals. So for the simple return rate, you'll see that I have a 48.04% return all time. And then for the time-weighted return rate, it's a 10.62% return all time. But that actually doesn't make much sense to me, and I remember seeing a different value in the app. So when I pull up the app, the number is actually different, and for the time-weighted return rate, it's actually 56.96% return all time. For some reason, all the other numbers on this page are actually the same except for this one. So I don't know if it's just a bug, but I think the number in the app is more accurate. Let me know in the comment section below if you're having the same issues here. Then the last two boxes here are the realized return all time and the dividends earned all time. So for the realized return all time, it looked like I lost $2,000. But I recently sold off a lot of holdings in my RRSP which were in the YieldMax funds. If you actually include all the dividends I've received while holding those, I'm actually in the green. But because I sold those and actualized those losses is why you see the negative $2,000 here. Now for the last box here is the dividends earned all time. So of the $38,612 total return all time, $33,205 of it was from dividends. Doing some simple math, that means 85.99% of my total return were from dividends. And all of that was reinvested into the accounts for compounding. I have some ideas on how to show this compounding effect at work, but let me know in the comment section below if you'd like to see a video on it. But for the top 3 holdings that paid me the most, it would be YTSL, HYLD, and TSLY. I actually don't own YTSL and TSLY anymore, so eventually these will drop out of the rankings. So that covers the overview of all the accounts. Now let's go back and look at each account individually. So scrolling down to show all the accounts, there's first the cash account, which I just opened recently to see what it's like, so there's not much in there right now. For the TFSA, it's currently maxed out for contribution room, so I won't be able to add more to it for this year. The rest of it is in a different account managed elsewhere, which is why it's a smaller account size. For the RSP, this is where I keep all the US holdings, but it contains some of the more riskier stocks that I might not feel as comfortable in sharing or recommending at this point in time. Then I have 2 non-registered accounts, one which is what I consider to be the main account that I covered so far in the past videos, and which I'll mostly be going over in this video. Then the other is a small margin account that I opened earlier this year, mostly because I was interested in learning more about it and also because it was newly released by Wealthsimple. The margin account only has $150 deposited, so the percentage value here will swing a lot. Because if the margin position loses $75 or $150 for example, then it would show a negative 50% or negative 100% loss. So if this shows a big negative loss in the future, I wouldn't be too worried because it's relative to the $150 deposit and not exactly to the performance of the underlying margin holdings. I won't be going over this account as well in this video, just because it's a bit more riskier than what I would recommend for most people. So let's now go into TFSA and take a look at what's inside it and how it's doing so far. So like I already mentioned earlier, this account was only started at the beginning of this year and I already maxed the contribution room. I actually didn't realize I over-contributed for a little bit, and that's why you'll see a sharp drop off recently in the deposits. But for this year, I put in $13,000 and currently the account is worth $14,717. We can now see some more insights if we go and click on the all-time return. So the details here are as already mentioned, where the net deposits are $13,000 and the all-time return is $1,717 with $754 of it as unrealized gains. Looking at the total return metrics and comparing to the app, it looks like both of these match and there are no issues unlike earlier. So for the simple return rate, it's the same as before at 13.21%, and then the time-weighted return rate is a little lower at 9.51%. This is probably lower because I over-contributed and then withdrew that money after I realized it, which may have then impacted this value. Then for the bottom two boxes here, if you remember from my last portfolio review video in January, I actually had USCL, QQCL, USSL, and QQQL in the account. Of course, we all know HHIS was released shortly after that, and then Q-Day as well just last month. Because I already had USCL and QQCL in the non-registered account, I decided rather than duplicating those same positions, I would just choose to focus on a different set of ETFs for this account. So that's why you see here that the realized return on this account is in the negative, where I had originally bought them in January, but then sold them before they all recovered. And that doesn't bother me to sell something at a loss, because I know the new positions will recover this amount back quickly, and in the long run, the small amount won't matter as much. We can already see that this is the case, where the all-time return above more than covers the amount of the loss I've actualized with the change. Now moving on to the dividends earned all time, you can see that HHIS is the highest payer so far, with QQCL and USCL rounding out the top three. Because I don't own QQCL and USCL anymore, these should eventually drop out of this list. Then going back to the count now, so on the 1 day we have a 2% gain, on the 1 week we have negative 1.69% loss, then on the 1 month we have a 1.7% gain, on the 3 month we have an 18.67% gain, and then on the year to date it's a 13.21% gain. Because I started the account earlier this year, and since it's easy to do, we can compare it to some of the indexes and see how it's performed so far. If I compare it to VFE, which is the unhedged S&P 500, year to date it's only up 5.93%. If I compare it to VSP, which is the Canadian dollar hedged S&P 500, it's only up 9.09% year to date. So this is important to point out that the Canadian dollar has outperformed the USD this year, so any unhedged stock or ETF is automatically underperforming by approximately 3% just due to the currency exchange rate alone. So because the TFSA has only contained unhedged ETFs so far since I started the account, and is currently outperforming VSP, which is hedged to Canadian dollar, is something worth noting. But because of the holdings being mostly in tech, it might be better to compare it to the Nasdaq index instead. If I compare it to QQC, which is the unhedged Nasdaq index, year to date it's only up 7.78%. So the TFSA still comes out ahead, but let's see if we use a Canadian dollar hedged one, will this still be the case? And again, it is also beating the hedged version of the Nasdaq. Just to keep in mind that the ETFs I have in this account are mostly in a concentrated selection of technology, so this performance is mostly because of the small selection of stocks that have done very well so far this year. If some of these stocks start to decline, the whole account will start to underperform, so it's always important to understand what it is you're actually invested in within these ETFs. Another thing to mention as well is that for the indexes, we're just looking at the price return and not the total return. So if we were to also include the dividends that were paid by VFV, VSP, QQC, and QQC.F, then the performances would be slightly higher. And scrolling down, you'll see just the two holdings in HHIS and Q-Day just like I mentioned. If you haven't seen my latest video on the Daymax suite from Hamilton ETFs, I would go watch it after this, because it describes why I think HHIS and Q-Day complement each other very well. I think this also works nicely because it pairs a monthly payer in HHIS with a semi-monthly payer in Q-Day, and they are also both unhedged when it comes to currency. You might be thinking that it's quite risky to going all in on these two ETFs, but look at my portfolio in a holistic sense in combination with a non-registered account. So while I might make up the entirety of my TFSA, in aggregate it is an 8.6% position overall for HHIS and a 5.3% position for Q-Day. I'll go into further details later on when we get to the spreadsheets, but now let's switch over to the non-registered account to see its performance. Here we now have what I consider the main account that I covered since the start of the channel. The value is currently at $95,900 with an all-time return of $36,210. I actually created and left this account empty for over a year before I finally made my first deposit in July 2022. And it wasn't until July 27th that I purchased my first stocks in Royal Bank and TD Bank. Since then, the account has grown to where it is now. Clicking into the all-time return for performance insights, we'll see some of the same values in the previous page. So the account is at $95,900 with an all-time return of $36,210 and $12,333 of it is unrealized. For the total returns, the simple return rate is 60.66% and then the time-weighted return rate is 10.59%. This, again like before, doesn't look correct, and if I were to pull up the app to verify, it actually shows a 56.78% time-weighted return rate. I'm going to have to agree with the app on this one as well, because a large difference between the values just doesn't make sense. Then, for the bottom two boxes, for the realized return all time, I've actualized a positive return of $5,696. And because these are all realized, I no longer own them in the account. A lot of these holdings I've sold are either for transitioning to newer products, or when I switched from traditional dividend paying companies when I first started out, to now having mostly all cover call ETFs in the portfolio. Next is the dividends earned all time. So like before, out of the all-time return of $36,210, $22,664 of it was from dividends. A large amount of it were from these top three holdings, NYTSL, HYLD, and USCL. I don't own YTSL anymore as I swapped it for the Harvest TSLY ETF during the year. But HYLD and USCL are and continue to be two of the main core positions of my portfolio, along with various others. Thinking about it now, HYLD is actually the longest held position in the portfolio after I started transitioning all my previous holdings to cover call ETFs. It continues to perform very well by keeping up with the index so far this year, and is even outperforming it at the time recording this video. Okay, going back now to the main page to look at the recent performance lately. On the 1-day return, the account is up 2.53%. On the 1 week, it is up 0.37%. On the 1 month, it is up 2.32%. And then on the 3 month, it is up 12.37%. For the year-to-date return, it is up 5.54% so far. Looking back 1 year, it is up 22.01%. And then the all-time return, as we've already seen, is up 60.66%. Now, scrolling down, you can take a look at all the holdings within the account. I won't be going over these individually here, because there are more details I can provide through the custom spreadsheets I have built. So feel free to pause here and take a look if you'd like, but next we'll switch over to the dashboard. Here on the spreadsheets, this is the dashboard that gives an overview of the entire portfolio with some projections. For reference, I forgot to mention earlier that this was all recorded on August 24th. At the top is a summary, and as you can see, I'll encompass both the TFSA and the non-registered accounts together. So on the day P&L, which is just the 1-day change, is a positive $2,596. Then for the total P&L, which is all the unrealized gains between both accounts, is a positive $10,312. And finally, the total return value here, which includes everything such as dividend distributions, actualized gains or losses, unrealized gains or losses, is at $38,128. Next is the average weighted yield of the account, and it is currently at 19.89%. If I wanted to also see the yield on cost, I can use the drop down to select it, and here we see it is 20.9%. Then lastly, this box is the projected annual dividends I can expect each year, which you may have already seen in the thumbnail, which is $20,434. For the chart just below, this is how the portfolio has moved since I started tracking it with the spreadsheet. So you'll see how the portfolio value, total investment, and deposits have evolved over time. Zooming in a bit now to see some of the charts and information more clearer. Between the two accounts, the portfolio is at $110,618. In total, there has been $72,546 deposited into the accounts, and the lifetime dividends collected are $24,127. Scrolling down a bit, we can take a look at the total returns by sector. We can see that in terms of total return, everything is actually in the green and providing positive returns to the portfolio. On the chart, you can visually see how much I've allocated to each sector, and how does the total return stack up to the amount invested. The largest sector is the exchange-traded funds, and that's what I'm using to group together all the diversified ETFs or index ETFs in the portfolio. You'll be able to see more clearly later on, where each one is categorized into which sector when we get to the other tab. But for now, we can go back up to look at some of the other charts and graphs. This first one here is just a comparison of the portfolio with the indexes. I should really just remove those lines for the indexes, to save myself some of the trouble of having to explain this every time I make a portfolio review video. The reason why I say this is because for the indexes, the lines are based on a single lump sum purchase at the inception of this portfolio. But this isn't reflective of how a portfolio sees contributions over time, and would lower the total returns as you invest more into the account. You can pause here to read more on the details, or feel free to watch my video on total returns after this to understand it better. So what this is here to show is just the relationship between the capital return, total return, and how it fluctuates over time. As a passive income investor, this divergence you see between the capital return and total return is natural and will happen over time because of the distributions being paid out to you. Next below is the projected monthly dividends. You'll see how I started with $13.42 back in August 2022, and then over time it's grown to over $1,700 a month. If we look back at the start of the year in January, you can see that I just hit the $1,000 mark for the first time. So it's come a long way in 8 months, and early next year should be when the portfolio will start seeing $2,000 in monthly distributions. Then lastly is the projected portfolio value in 10 years. So for 2025, the goals were to hit approximately $111,000 for the portfolio value, and then $18,447 for the annual dividends. Currently, we are basically $600 away from hitting the portfolio value goal, and I've already well surpassed the annual dividends goal. Of course, we can't predict what the market will do, and this is assuming the market will continue to go up for the next 7 years in a row. But so far so good, and we'll just start to work on next year's targets a little bit earlier. So here's where all the details are and contains all the holdings from both portfolios. I'll filter through some of these columns so you can get an idea of how these have performed so far. To make this easier to read, I'll zoom in so you can see everything more clearly. Now that you can see all the holdings, I can quickly summarize how they're categorized or grouped by sectors. The largest one is the exchange traded fund sector, and again these are just any ETFs that holds more than one company or stock. If you're familiar with each of these I've highlighted, they are all diversified in the sense that they contain multiple holdings within them, or are index-based. Then the next largest one would be the technology sector. These ones are going to be all the single stock names that are tech-focused. As you can see, it's most of the Magnificent 7 stocks, and then some of the names that I'm interested in investing for the long term. The holdings for this sector are going to be more opportunistic, so only if they have sold off or are at a discount. This is because single stock ETFs carry much more risk, so the timing of your entries matter more significantly. Next, the third largest would be the crypto sector. At the start of the year, I was only starting to invest in crypto, and it only accounted for about 2.5% of the portfolio. Now, after a lot of changes, I've also started to add some Ethereum as well, to make crypto have a larger 15.8% allocation overall. I originally planned to only have a 10% allocation, but now it's crept up to 15% and might actually get up to 20% at this rate. I've been watching it fairly closely this year. I think there's more upside to go and that it's not too late to start building a position. We'll have to see in time how it plays out, but you have to approach these with a long-term mindset and not worry about the short-term volatility swings. The next two sectors are energy and financial services, both of which represent the extent of my Canadian exposure. These two are currently at full positions, or where I like them to be right now, so I likely won't be adding more to these in the near term. They are relatively stable sectors that I don't have to think about and can hold well into the future for their consistent distributions. Lastly, I just have a relatively small position in Aduro Clean Technologies, which I've held for the past 2 years now. It's a small cap play that focuses on plastic waste recycling and has really taken off this year. I started buying into it at around 90 cents and $1, but then they did a reverse split to raise the price in order to be listed in the Nasdaq index. This is my first holding to reach 100% in total return, and I'm still holding because I think there's more to go if the good news continues towards the end of the year. Okay, that covers and breaks down the sector allocations of the portfolio. So now let's get into some of the numbers you've probably been waiting to see. The first column we'll filter by is the amount invested. Here, the top 5 holdings for this are QQCL, USCL, HYLD, HHIS, and TSLY. With the exception of TSLY, all these are core holdings that are mainstays in the portfolio. I wouldn't recommend making Tesla this size in the portfolio for most people, because it's been a roller coaster ride for the last 2 years, but in the long term I believe it will play out eventually. As for the bottom 5 holdings, they are Leith, CNYE, Nefli, ACT, and HBTE. Leith is the newest position to the portfolio and was just added a few weeks ago. This is a leveraged growth position, so it doesn't pay out any dividends. Other than ETHY from Purpose Investments, which isn't leveraged, there are no other cover call Ethereum ETFs out there. The growth and upside potential of Ethereum is very high, should it play out in the next few years. So I actually don't mind fully capturing this with the additional 25% leverage on top, if the value can continue to double or triple going forward. I'll be slowly averaging into this position for the remainder of the year and see where it goes. As for the others on this list, except for ACT, They are all newer positions to the portfolio, which will slowly build up over time. Moving on, we'll now sort by the total P&L, which is the same as the unrealized gains or losses for each holding. At the top, we'll have ACT, YGOG, HTAE, HYLD, and USCL. I've already gone through ACT earlier, and even though this currently represents a 128% return, I think there's still more room to go on the upside. So while it's tempting to take some profits right now, I'm just going to keep holding it. Next to HYLD, YGOG is probably the next longest held position in the portfolio. The underlying stock just recently hit all-time highs again, and this is going to be a long-term hold through the surge in AI. With the bottom 5 holdings, we have MSTE, AMHE, ENCL, CNYE, and QDAY. I'm sure many are aware that MSTE has taken a hit lately and might be getting a little bit worried. Personally, I'm not worried at all, and would probably remind everyone to understand what it is they're actually invested in, rather than just looking at the yield. MSTE is going to follow strategy, or formerly MicroStrategy, and significant drops should be expected because of how volatile Bitcoin is. So if you believe in Bitcoin and the approach Michael Saylor has taken with the company, then this should be a great opportunity to lower your average and buy cheaper shares. Nobody can predict when the bottom is going to happen, but I've been adding here and there in order to lower my average cost. But also remember to take into consideration your portfolio allocation, because while it's cheap, you don't want to have more exposure than you can tolerate or willing to lose. There's a saying that if you start to get too emotional about your position, it means you've over-allocated or have now made it too big of a holding. If that's the case, then I would consider to either size down or to stop adding more to your position and focus on other holdings in your portfolio instead. What also helps is if you have a spreadsheet or app that tracks the total returns for you, meaning that includes the distributions that have also been paid out. So if I add those back into the return, I'm actually still up on the position by 0.12%, despite it showing a negative $812.28 unrealized loss currently. Hopefully some of these tips will help you in understanding and managing your own portfolios in the next market pullback. Then the next column is going to be the annual dividends column, which shows how much I can expect to receive from each holding in the portfolio. The highest yielding holdings are TSLY, MSTE, HHIS, QQCL, and Bank. So while I advise not having Tesla being one of your larger positions, it is the highest distributing one in the portfolio currently. Along with MSTE, these two holdings make up almost 30% of the annual distributions. Again, both of these are very volatile stocks, and if you can't handle seeing your position fluctuate, I'd probably avoid them or make them smaller positions in your portfolio. For myself, these are probably where I would like them to be in terms of position sizing, and won't be adding too much more to them going forward unless they are tremendously undervalued. The remaining ones here are stable core positions I can count on for their consistency. As for the lower yielding positions, they are Nefli, CNYE, YGOG, MSHE, and HBTE. Most of these here are just due to the nature of being newer positions in the portfolio, or are lower yielding for the purpose of also capturing more of the upside growth. Now that we've seen the annual dividends, we can now filter by how much I've received in terms of lifetime dividends over the course of each holding in the portfolio. The ranking of the top 5 are HYLD, USCL, Bank, TSLY, and ENCL. Just by the nature of being the longest holding in the portfolio, I have HYLD at the top. It's not the highest yielding position at about 12.61% at the time recording this video, but has been very consistent and has even raised the distribution 6 times since the start of 2024 last year. USCL is also very similar in nature to HYLD, but it just hasn't been around as long in the portfolio, which is why it's in second place. It's had some variance in the distribution lately, with some raises and some decreases. But in general, the distribution is still higher than what we started with at the beginning of this year. Bank is another one of those consistent and stable paying holdings, and has raised the distribution 3 times now since 2023. For TSLY, just by nature of its high yield, it has caught up to and cracked the top 5 in just the 5 months I've owned it. I can see it claiming the top spot eventually if given enough time. Just like Bank, ENCL is another one of those consistent and stable paying holdings. This year, it has lowered the distribution twice, and then raised it back up just recently. While it's not back to where we started the year with, this decrease is for the stability of the fund and payments to shareholders. It's still yielding about 16.8% at this point in time, so while it isn't the 18% it was previously, this is still a great yield that covers the Canadian oil and gas sector. As for the bottom 5 holdings for lifetime dividends, they are going to be at $0 or very low, because they either don't pay distributions or are too new to the portfolio. So now that we've seen the lifetime dividends, we can now sort by the total returns. This shows which holdings have performed the best when we account for both the unrealized returns and the distributions that have been paid out. So at the top we have ACT, YGOG, HTAE, HYLD, and NVHE. ACT is the first holding in the portfolio to reach over 100% returns, and I think it can go even higher still to reach 200%. The highest I've seen it at has been 155%, but it's been trading down a little bit lately. For YGOG, I'd started buying into this at the right time, which was in 2023 when the tech sector was just starting to recover. It's been a very solid performer as you can see, and it's one I'll probably be holding for the long term. Both HTAE and HYLD have always consistently been near the top for performance, which is why I've held them for this long and added to them occasionally. I haven't put more into them in the past year though, because I'm happy with their allocations currently. And there are other positions I'm more interested in adding to or have been building out. For NVHE, I've actually gone back and forth on this one a few times because I thought I had missed the boat already. So I bought into it and then sold out of Nvidia twice now before this current position in it. Both times I sold it for a very small profit, but this time I took advantage of a dip to start a position and slowly add it to where it is now. On the flip side, for the bottom 5 holdings, we actually have no holdings in the red for the very first time I think. I had started investing in 2022 when we were in a bear market, so there was never a point where there wasn't at least one position in the red. Now finally, this is the last column we'll go over, and it's the percentage of portfolio or allocation column. For the top 5 positions, they are QQCL, USCL, HYLD, HHIS, and TSLY. Just one thing to keep in mind for this column, and that it is based on the amount invested and not the current value within the portfolio. So if we take QQCL for example, it is a 9.05% allocation of the portfolio from what I've invested into the position, and the value doesn't include any of the growth or distributions collected since I've owned it. In general, for a 20 holding portfolio, that would be an average of 5% per position if you equally weight them. So the fact that the first 2 holdings make up just over 18% of the portfolio is by design, as these are index positions in the S&P 500 and the Nasdaq 100. The allocation should probably be higher, but I also have other holdings like the next 2 in HYLD and HHIS, which could also be considered as concentrated versions of the 2 indexes. If we add these 4 together, it would then come to a 35.44% allocation between them. There are some others in the portfolio that I would also consider diversified or index-like as well, but these 4 form the largest part of the core holdings. Then rounding out the 5th spot is TSLY, which again I would probably not recommend for most people, but is here mostly as a long-term hold and yield booster. As for the smallest 5 positions in the portfolio, we have Leith, CNYE, Nefli, ACT, and HBTE. There isn't too much to say for these, as they are either new to the portfolio or riskier positions I want to keep small in case they don't work out. And with that, I'll wrap it up here for the portfolio review. I could probably keep going for over an hour because there's just so much I could go into, but I'll save that for some future videos. If you made it this far into the video, comment with the word success down below so that I know you made it to the end. I haven't prioritized these portfolio review videos too often because it seems like they generally don't perform as well as some of the other videos on the channel. So if you could like the video and subscribe, it'll give me a better sense of if I should do these more frequently or not. Thanks for watching until the end, and I'll see you in the next video.